Hi, hello, thank you. Wonderful that you're all here to this important panel. I think without further ado, I would like to ask my panelists to the panel. And we have Mr. Christian Esters. He's Managing Director, Sovereign and International Public Finance Ratings at S&P Global. Has years and years of experience in this field. And also, I'm very happy to have Dr. Daniel Cash here. He's a senior fellow at the United Nations University and an associate professor at Aston University, holds a PhD on credit rating regulations and has published many books and many articles on the subject. And I would have had more cards here introducing more panelists. Up until Sunday, I had 3 more cards. But I have to address this male European elephant in the room, and I'm really sorry. Again, I think the first person who had to say that she cannot come contacted us on Thursday, and the last contacted us on Sunday. We tried everything to have a more diverse panel, but we're just unsuccessful, also given the really short notice from Sunday or Thursday last week to today. So I'm deeply sorry about this. This is not what I think the HSC and also what one and we all strive to have in terms of diversity, but we tried everything and did not succeed. Now to the subject matter. I think the COVID pandemic exacerbated and really brought to the broader public attention the problem that many African countries have, and I think many did not in the beginning see that the COVID pandemic was really an economic crisis, mostly for the African continent. It exacerbated the debt situation, the debt distress that many countries face on the African continent. And it also showed that they have a real challenge in accessing affordable capital. And that means that they have to often pay much more in debt service than they can invest in health, education, infrastructure. So it's a really big problem, because if you don't invest in those sectors and those important issues, it will also hamper your economic growth, and it will just it then makes you enter a vicious cycle. And we would like to speak about and that is mainly or also caused by the fact that the international financial architecture is not working in favor of many African countries. And one element of that, and I'm not saying the most important, but one element of that international financial architecture, and they play an important role, are credit rating agencies. And also they do play a role for the fact that the international financial architecture often doesn't work for African countries. So we would like to focus here on the panel, and then later with you as well. And I make sure to give a lot of time for questions and remarks from the audience. So that's also, again, a note to you two to be brief. On what we can do concretely to maybe have some positive progress on this element within the larger systemic challenges that we are facing. Just to give you a few details laying out the frame, only 2 African countries, or only 1 African country, I think, has an investment grade rating out of more than 30 that are currently rated. African countries pay an average of 11.6% interest on their bonds, regionally the highest of anywhere in the world. Sub-Saharan Africa pays 2.1% more on average than any other region. And nearly $75 billion could be saved, that's according to the UNDP, for African countries if credit ratings were less subjective. And the big 3 credit rating agencies, S&P Global, Moody's, and Fitch, collectively only have 3 offices in Africa, and all are in South Africa. 44% of all African debt is now owed to private creditors. That's also different from the debt crisis that we saw in the beginning of the 2000s. And that makes it, of course, makes restructuring much more difficult outside of defaulting. So again, we would like to focus on solutions, on what can be done. My first question would be to you, Daniel, and then also to you, Christian. What do you think is the biggest challenge facing the relationship between sovereign countries and credit rating agencies?
So for me and the work that I do, the biggest challenge that we see is essentially an issue of collaboration and investing in capacity on the ground. So in terms of collaboration, what we're seeing is that there are some fantastic initiatives on the ground aimed at building capacity, aimed at increasing that skill set that particularly African countries need, because that's my research focus. But we see a divergence in approach sometimes, which can be good, but it's not usually connected well. And then also you have this dilemma at the moment on the continent where the countries are squeezed in terms of their fiscal space, but it's at the exact same time that they need to invest in that capacity to learn better how to engage and navigate through what are often sometimes overly technical waters in the credit rating space. So there are some fantastic initiatives and capacity that's being built at the moment, but more needs to be done and quicker because of the challenge that the African countries are facing at the moment.
And what would be your solution intervention if you had 3 minutes to outline what you would do?
So as I did say, I was going to be greedy and I was going to offer 3 solutions essentially. So in my work with the United Nations University, we've just published a paper and we have 3 particular recommendations. A paper that came out earlier this year from the UNU looked at what the Global South was requesting in terms of international financial architectural reform. One of the things that they were categorized as requesting is essentially a space on the world stage to inject African viewpoints in the architecture. So the first solution that we came up with is most credit rating reform on the international stage starts with the International Organization of Securities Commissions. On their particular Committee 6, that looks at credit rating activities, they have 16 members. There is no African member as we speak. And what we suggest quite simply is probably the lowest hanging fruit. Either an African member applies to join the committee or the committee requests that African members take part in that committee. And that will hopefully start the ball rolling in terms of on-the-ground structural reform, particularly in terms of regulations. The second recommendation that we put forward was the credit rating agencies either voluntarily or as requested by regulators, they should inject granular detail in terms of what public sources they're using when they're doing their methodologies and applying their methodologies. As we speak, they passively tell us what they may use in certain circumstances. We suggest that they should publish a specific list with every credit rating action. And the final thing that we suggest is that the end goal really should be Pan-African credit rating regulation across the continent. Now, there are a number of steps that need to happen in order for that to take place, but that should be the end goal. And within that recommendation, my urge and my call, maybe to people in this room who have that power, and I see a couple of you, this has to be maintained on the global stage as an issue. It cannot be cyclical as it has been before. It has to be maintained. So I was really pleased to see the Chancellor this morning reference credit rating agencies, and in future Hamburg sustainability conferences and future Pacts for the Futures and things like this, it has to be maintained at the forefront of the international agenda. So my apologies for giving 3 when you asked for 1.
But you stayed in the 3 minutes, so very good. Thank you. Christian, over to you.
Right. In terms of challenges, I mean, maybe let me start with the challenges for the sovereign ratings. So we actually, S&P Global, we rate 25 sovereigns in Africa. Most of them, yes, in the single B category. 3 of them actually currently in default. Some of the common weaknesses and challenges for the rating would include relatively low GDP or GDP per capita levels, often a concentrated economic structure. That also means often concentrated export of foreign currency revenue and concentrated or vulnerable fiscal revenue, and that of course makes them vulnerable often to external shocks. The second challenge is, I think, Stephan, you mentioned that the debt levels. Debt has increased quite substantially over the past couple of years. The pandemic or the crisis during the pandemic has contributed to that quite substantially. And in particular, if you look at debt as a percentage of revenue, not GDP, which is often a measure, but over revenue, fiscal revenue, debt levels are very high in many cases. And then third, we often see institutions as a weakness, the predictability of policy making. I want to spend a few thoughts on data issues. Data issues, we discuss a lot of data with the authorities. We visit those countries typically at least once per year. We meet ministries of finance, we meet the central bank and other institutions, and we try to get our hand on the data, of course. Credit committees, our internal credit committees, also discuss the data very intensively. And yes, I think we would sometimes benefit from more data. Would it move the needle substantially for individual ratings? Maybe that's another question, but certainly there are gaps and issues with the reliability of data. Our preferred data source is the national authorities or statistical office, central bank, and so on, if it is available, if it is reliable. What is important, and that comes back perhaps to the challenges, Stephan, you asked about, in our discussions, in our engagement with the authorities on the ground, it is important for us that the authorities, the government, owns the data. What do I mean by owns? So when we discuss the data, we want to understand what is the reason for possible data revisions, in particular if they're substantial. What is behind the transition between a forecast that we heard about maybe 6 months ago or 12 months ago and now the actual data? Of course, that happens in all countries. Yeah, you deviate from budgets. Or your GDP forecast doesn't apply. But we want to understand what is behind, what is the reason. And that's a discussion we have with all sovereigns globally when we rate them and when we discuss the data. We would probably benefit from forecasts that are realistic, because also internally, when we discuss the credit rating and the forecast in our committees, we need to present realistic forecasts. And of course, it's helpful to hear about data updates in a proactive way. So again, that's the question about ownership. So the data doesn't have to be perfect. I think we all understand the limits of perfect data collection, but we are very much interested in a very active dialogue with the authorities in all sovereign countries, in particular in Africa, on data. So we understand the data and we can explain and put an economic rationale behind the data.
And your solution, if you could describe it very briefly, what could be in your thoughts on really concrete solutions to face some of the challenges?
Right. I mean, on the let me give you maybe on the sovereign rating level one example. You pointed out there's actually one sovereign in sub-Saharan Africa that is investment grade rating, and that's Botswana, BBB+ rating. Why is that? Botswana set up I think in the mid-1990s a sovereign wealth fund, the so-called Pooler Fund. That keeps part of the diamond export revenues for future generations. That is the idea. So this Pooler Fund today has about, I think, $4 billion. That's 30% of the country's GDP. And that helps with quite a number of our key credit metrics. It helps with the import coverage, so foreign currency reserves over imports. That's an important metric. It also means that the country is an external creditor with respect to the rest of the world. And if you net government debt, which is fairly low already, against government assets, you broadly get to 0. And that's very helpful for the sovereign rating. Botswana's BBB+ rating is higher than Italy's rating and is higher than Greece's rating at S&P. Another example, perhaps, we upgraded a few months ago Benin on resilient growth that was supported by domestic reforms. I think that demonstrates that the domestic policy agenda can make a difference for sovereign ratings. On the data, I think is there one solution? I think the solution, in a sense, is continued engagement. I mean, we continuously look into our criteria and methodologies. So we have sovereign rating criteria, corporate rating criteria that are publicly available on our website, free for everyone to download. So I think it's also it's our interest also and our desire to continue developing those methodologies. To give you, for example, what we've done more or less recently, we've clarified our criteria when it comes to debt for nature swaps. That's just one example. We have published criteria also. Now, this is a bit not outside sovereign specifically, but on multilateral banks and MDBs, hybrid capital, for instance, how we would assess that, and a number of other assessments, sustainability-linked bonds and others. So I think that is one solution from our side, how we try to contribute to that novel transaction and reflect innovations, financial innovations in our criteria.
Daniel, what do you react to that? Do you think that is good steps in the right direction? And what else and who else maybe needs to be mobilized?
I think it's good steps from the credit rating agencies, but I think it's the first step. It's not all they could do. And I think what really needs to take place, and quite often it doesn't, because you have a lot of antagonism, for want of a better word, between sovereign debtors, particularly in Africa, and credit rating agencies, quite often for valid reasons, but sometimes it's just a mismatch of positions that it sounds very wishy-washy, but you need more collaboration. So what we're seeing on the ground, I'm part of a UNDP initiative, where essentially we're injecting capacity building so the country doesn't have to pay for it, we essentially provide it. And what we're seeing is a massive acceleration of understanding and nuanced position playing from particular ministries, from particular people within the countries we work with, because it's worth remembering in 2001 there was 3 countries on the continent rated. In 2002, UNDP took S&P onto the continent and provided the service essentially, and I think it went from 2 to 13 or 14. That shows you how essentially young the capacity is on the continent to deal with these issues and to understand when a analyst comes to town, how to approach them, what data they need, how to talk to them. We've had conversations with particular people in particular ministries, and they say, oh, we didn't know we could do that. We didn't know we could ask this question. We didn't know we... And it's about building that skill level. The countries have to do more, but so do the credit rating agencies, because you could have a collaboration where credit rating agencies take part in these types of initiatives and provide that underlying skill set boost so they explain what they want more, and then that would shape it more. And that's where, when I'm talking about a credit rating agency listing the specific data sources they use, I don't say it to increase the request for transparency necessarily. It's to help with capacity building. It's to help with the countries to let them understand more how they'll be rated, in what circumstances they'll be rated, with what data, and things like that. So we've seen last week, I think it was Senegal, they've had issues where they've gone in with an audit and seen that over the past few years, before the new regime came in with the government change, the data hasn't been where it needed to be, and I think they've suffered a Moody's downgrade as a result. That's just one small example of the underlying issues.
Thank you. And Christian, also reacting to this, and maybe also explaining what, from your perspective, needs to be mobilized, who needs to be mobilized, what would be also a conducive and helpful, like, systemic steps that could also help you or credit rating agencies to tackle some of the challenges that we see.
Yeah, I think it's the question about ownership of the process. I mean, we typically, as I said, we typically visit also the country, the government, once per year on the ground in every country. So it is, in terms of capacity building, very helpful to have to know who you get information from, who to contact if sort of the analyst on a country sort of reads something in the news, you want to pick up, I don't know, the phone, the screen, and get in touch with someone. So who can you contact to get a confirmation of what you maybe read somewhere, Bloomberg or something, or you get a clarification how the situation really is. I think that's very important. This ownership also from the government perspective or from the central bank, that is sometimes our main contact, to have some accountability or some response to rating agency, to investors in general, I think, to markets when there's news out there that may raise questions and that may require clarifications.
What can be done by actors such as Germany or the G20 or other international, the UN? Is there any specific process or reform steps that you would like to see, or what would be a realistic target? For example, if we meet here next year, and the Chancellor has said this morning that he wants to see this topic on the agenda of the HSC 2025, what would be some of the concrete things and realistic things that you think could be achieved by then?
Right. I mean, I think the mobilization of private capital through MDBs, I think that's a very, very helpful initiative, I think. Then on our side, again, I think the data question is something where it would really be good to see progress. Maybe I think these are probably the 2 points. On our side, as I said, we continue to engage in developing our views, on our criteria, on innovation, on new transactions, new type of transactions, and we're also committed to be as transparent as possible, because that is often a question that is raised. So how transparent are those ratings? We publish reports on the ratings. We publish the scores that we derive from data and sometimes qualitative judgment to get to the rating finally. So a dialogue on that, on the level of transparency, is that sufficient or not? I think that would also be helpful for all stakeholders. And to give you one example, we're publishing all the scores now for our, not the final rating only, of course, but the different scores that we come up with that feed into a sovereign rating, like an institutional assessment score, an economic assessment score, and so on, monetary assessment, fiscal. That has not always been the case. So we introduced that a while back, driven by the initiative of an important public stakeholder, actually, who wanted to see more of that, and we introduced that globally, actually, in all our sovereign publications. So to hear that feedback, what level of transparency would be helpful, that's very important for us.
Daniel, what do you think? And Are those realistic steps? What would you see realistic? What would you like to celebrate next year when we stand here in a much more diverse panel? Do we have the right process? Do we have the right fora? Is there something that we need to tackle?
I think, so I was in New York last week and the week before, and there's a few panel side events, and the question kept coming, what can we do? One, that should be celebrated. That's a good question to ask, because with credit ratings, historically, it's been very cyclical. When there's a crisis, there's interest, and then the crisis falls away and the interest goes away. So I think asking what we can do is the best question you can ask. But as you said, there is no silver bullet, A. There is not one thing you can do. It's a case of, for multilaterals, it's definitely a case of keep it on the agenda. I would also urge anybody when they're engaging is to have a diversity of thought. With something that's technical like credit ratings, you can't just go to the credit rating agent or former analyst, because you need that diversity of thought. You can't just have the big three repeating back to you what they want, what they think you want to hear. The second thing is credit rating agencies and credit ratings are a very delicate subject to understand. That's why you need a diversity of thought. So, for example, with transparency, there has been a number of steps done, especially through like the PRI and things like that. But then if you have a better understanding of credit ratings, you know they can't be fully transparent. When you're talking about the things that go into a methodology, a credit rating committee is behind closed doors. You don't get to find out what happened, even though you publish the scores. These type of things you need to know, because what that allows you to do then is build a realistic reform package that you can do. So we saw post-global financial crisis, a lot of regulatory capital paid into things like increasing competition. It didn't work because they didn't really understand what they were essentially trying to regulate. I think what needs to be brought forward really is you can have, so for example, there are a number of requests out there, mine included, but there are some others, in terms of granular requests, i.e. the data thing I mentioned, IOSCO. There's been things that have said when a credit rating agency, for example S&P, when they publish a rating action, they should have to split it between qualitative and quantitative. So you get to understand where the subjectivity is in that credit rating action. That's a granular request, could be of interest, and you could push that forward. But you need the different levels of pressure. You need that granularity to say, you could think about this, you could think about that, but you need the overarching political pressure, and that's what the likes of the UN, the HSC, that is the role they play. They don't have to come out with a silver bullet that they've said they've solved everything, because that does tend to happen in this field. You tend to get different parties, and they're trying to be the one to fix the problem. And when you have that, you don't get that cohesion that you move, because essentially, when it boils down to it, this is a systemic problem. The only way you resolve systemic problems is with systemic solutions. It can't be piecemeal. It can't be essentially borderline egotistical. I was the one who fixed it. It needs to be cohesive and conjoined.
Would like to get back to the specific suggestion you made, but just one follow-up. Do you think we have the right process? Do you think we have the right political pressure to achieve something realistic by June, I guess, 2025? Or what would be your...
Well, I think it's growing because, I mean, we have things like this. There was a closed panel just before. Yeah. It was mentioned by the Chancellor this morning. It's in the Pact for the Future. There's a momentum growing, and it has to be on the agenda, because to meet the SDGs, you need private capital. You can't achieve it without it. What we're seeing now, which is something I call the credit rating impasse, the mechanisms that used to take place in the 2000s in terms of debt relief, in terms of debt wipeouts, you can't have that anymore. There's reasons why you can't have that. A private creditor can't wipe their debt for many reasons, mostly legal, but you also have internal rules within a private creditor, mostly their asset managers, which means they cannot participate, and that's why you have only 4 countries participating in the G20's common framework. 3 countries are in default, and 1 of them is unrated. That's the only way they could participate, because if they did, the theory, and I'm not saying S&P have done this, but the theory is the credit rating agencies will immediately put you into default. And that's why all the countries have been actually quite articulate saying we don't want to get involved. So you have this impasse because now the environment has changed. You don't just have ODI, you don't just have countries lending to other countries, you now have a different player in the game. So the rules have to change. You can't use the old mechanisms, and that's what the G20 have recently found out.
Thank you. Christian, the specific example that Daniel said about segregating between the qualitative and the quantitative rating, do you think that is something that could be done? Do you also see that as a good way forward? And also for you, do you think that we have the processes, we have the pressure? Where would you like to see this being taken forward until June next of year? And then I would like to open it to the floor.
Right. Yeah, I think, the distinction between quantitative and qualitative assessment, I think that's absolutely possible in a sense, and it is to some extent happening. Of course, every rating agency has their own methodologies and their own way how they publish or explain their ratings. I can only speak for S&P Global Ratings. So when we publish these individual scores that feed into the rating, there's an explanation how we get to the score. And if you read it carefully, you can understand to what extent this score is driven by a key metric, like, let's say, GDP per capita, or like debt over GDP, right? So that's the starting point often. That's a purely quantitative metric. And then on top of that, there are certain, we call it adjustments. Now, are all those adjustments qualitative? No, they can also be quantitative. And that makes it maybe sometimes a bit difficult to disentangle what is qualitative, what is quantitative. To give you an example, if we to the economic score, which is driven by per capita GDP, we can make adjustments. For instance, if the economy is concentrated in one sector, so we publish and say, look, this sector, I don't know, mining or whatever, has more than 20 or 25% of GDP. Hence, we adjust the score. So is that a qualitative adjustment? No, but it's driven by data, but at the same time, it's not our key metric, which is GDP per capita. And I could give similar examples for other scores. Then there's also something that's really qualitative, and that could be something like the debt payment culture of the government as informed by previous defaults. So that is also an adjustment we can make. Yes, granted, that is very much qualitative, of course. Yeah, so we don't count the number of defaults and we don't cut off at 1, 2, 3 or so. So this is more a question of what is the recent track record of payment behavior and how often did maybe this sovereign default in the past. It is possible, but it's not as easy, I think, just to say this is the quantitative model or starting point, and these are all the qualitative overlays that we use. That's perhaps it can be a challenge. In terms of pressure, I think we have an ongoing dialogue with policy makers, with regulators, and often actually you may sit at the table with one government representative one day, and then they represent more the European regulation, and you hear one thing in terms of transparency. Don't grant exceptions in your ratings. You have to follow your criteria by the word. You have to act immediately if the data changes and to explain. So don't be late with your rating changes. And then you may talk to another government representative in another role, and then maybe the interest is exactly perhaps the contrary, where exactly we have discussions then about, okay, shouldn't we, when it comes to a DSSI or the common framework, so is there a problem if a rating agency downgrades immediately if a sovereign engages in this process? So I think also from the government side, sometimes there are different interests, how they want to push or what they want to push rating agencies to do or not to do.
I suspect it depends on which ministry you talk to.
Exactly.
And I don't think you thought it was easy to do that separation.
Well, I'm not disowning it, but that's not my suggestion. That's from a UN DESA paper in 2021. And in reality, I don't think you'll ever see it for a reason that we haven't discussed, which is liability. I don't think a credit rating agency wants to be exposed to this is precisely why we've done what we've done, because if it goes wrong or someone isn't happy with it, you have potential liability issues. I'm not saying that would be the case, but that's another issue that comes into it.
Thank you. I would like to give the audience. Thank you. Please, in the front, yeah. There's a micro somewhere. There. Yeah. The lady in the front, please. Please identify.
Make sure the album.
Yeah.
Hi, my name is Jana. I'm Jana Horace. I'm an economist. My question is around fiscal rules and fiscal councils that have been adopted widely also on the African continent in the last, I think, decade. So I would be very interested in hearing your assessment on what the impact is of debt rules, budget rules, revenue rules, and also maybe in communication, the fiscal councils. Would they be an instrument that helps the enforcement of such rules? Thank you.
May we collect 3 questions? And there was one in the back.
Where? Oh, okay.
Thank you very much. My name is Albert Mchanga. I'm from the African Union. I'm a commissioner. One of my responsibilities is finance. And the first question is, when did Mauritius lose its credit rating? Because so far we have assumed we have 2 African countries with investment grade, namely Botswana and Mauritius. Now the next one is not a question, but a statement. First is that, especially from the colleagues from the rating agencies, it would have been very useful if one of the panelists is the one managing the credit rating office, one is one of the big 3, so that they bring their experience, practical experiences on the African continent. Now, related to that, there's one issue which has not come up, and the issue is that we at the level of the African Union are in the process of coming up with an African credit rating agency, and it's to be managed by the private sector. And the number of key issues that we have, sorry, just a little bit, so that you're aware of the background. A few responsibilities that we have to given it is, 1, human capital development. We agree with you. We need the capital market analysts across so that they are able to really advise governments on the content of each report. Number 2, is the issue of information, statistics. Work with the governments to ensure that they have up-to-date information which can be used in their assessments. And number 3, advocate for ensuring that all African countries are subjected to credit ratings. So far, 21 African countries are not rated, so we needed to universalize it. And then when they've done that, now they start doing credit assessments on the African borrowers, not international borrowers, so that they build their reputation. And finally, giving secondary readings to the reports of the big 3, so that they are able to see what is wrong, what is right, and we provide that level of assessment. Thank you very much.
Thank you. One short mention. 2. If you're very sure, we can do 2.
Okay, I will try to be short. My name's Mark Boland. I'm a credit analyst at Red Intelligence in London. So my question is on domestic debt, which for a lot of these African sovereigns are rated as the majority of the interest costs. I mean, to Daniel, how do you take into account that? And to Christian, I mean, I know, well, you probably have similar challenges when it comes to maturity data, and a lot why there's so much domestic debt is because it's, very difficult to borrow to corporates. There's a lack of information, but Moody's did have a takeover of GCR ratings, which I think they completed only a couple of months ago. And of course, you want to develop the number of corporate ratings in Africa, but at the same time, the sovereign ratings are getting downgraded, and that's often, the threshold for how high the corporate ratings can go, and how do you meet that challenge, and what are you doing kind of more proactively to increase your corporate bonds rating in Africa? Thank you.
Do you pass it just to the front? And then we have 4 more minutes, so very brief.
Thank you very much. My name is Amadou Hott. I'm a former vice president of the AFDB and former minister of economy of Senegal. Often, even when we have the same rating with a country that is in another region, let's say BB plus, same, we tend to pay up to 500 basis points more when we issue bonds on the market. Can you maybe explain a bit why that happened and how could we resolve it? I know there are sometimes liquidity issues, but the cost shouldn't be up to 500 bips. It's too expensive. Thank you.
Briefly.
So very quickly, yes, that helps, but it's just one part of essentially what is debt management and how that's communicated with analysts when they're on the ground. In terms of the African Credit Rating Agency, I mean, I didn't want to talk about it too much because it does tend to dominate these events, but that was one of the excellent initiatives I was talking about on the ground. I'm fortunate enough to work with Mishek and the APRM on this type of issue. The African Credit Rating Agency can do lots of things, it can't do everything. It will never take over the big three, it will never beat the big three, but it can do things like increase capacity building on the ground, like you mentioned. It can help with SME ratings, it can help with domestic debt. When you're talking about domestic debt, Euro bonds are only a very small, well, not small, but a portion of this picture. That's why something I do want to say, and believe me, if you've read my work, I'm no champion of the credit rating agencies, but they are not the be-all and end-all. This is it's a massive machine, and they are a cog. I think when you're talking then about the basis point and the difference, I think Kenya's a really good example recently where they're paying over the odds, even though they're 6-7 times oversubscribed. This is where the complexities of what we're dealing with need to come out, because when you understand Euro bond issuance, credit rating agencies are only a particular part of that process. When you look at what the investment banks are doing, where they're starting it and arranging these deals, they're conflicted because they could essentially get these Euro bonds into the market for lower basis points, but they may not get their sale, and they need their fees to get the Euro bond through, and they almost guarantee it. When you're selling Kenyan debt, for example, at 10%, for example, and that's what the market takes it as, and it's 7 times oversubscribed, you're almost guaranteed to sell it. So my final, before I leave it to you, Christian, credit rating agencies are essentially all my life's work. That's all I focus on. So I sound a bit stupid saying this, but they are not the be-all and end-all. You have to know exactly what they are, what they do, and what they don't. And if you understand that, you then can then build realistic reform packages, but then it has to be targeted and you have to know what you're aiming for. And that's what I was saying about like the Eurobond processes. You understand it's all different parts of a long story. Sorry, Christian.
Yeah, no. Okay, so I'll try to be quick as well. So on the fiscal council, fiscal rules, yes, actually we sometimes talk to fiscal councils also to get their views on the fiscal trajectory and expectations. Fiscal rules, that's a bit more ambiguous. So we usually consider they're helpful because they typically anchor fiscal policy and probably or hopefully make it more predictable. But we don't rate, of course, with those fiscal rules. So it's not like if you break your own or someone else's fiscal rules, I don't know, in Europe or so, that we would react with the rating. Of course, we have our own criteria. Mauritius, yes, is rated BBB minus, absolutely. What was the other question? Yeah, okay, so African Rating Agency, I mean, we always welcome competition. Even the sort of what is usually called the big three global rating agencies, of course, we have different criteria. We see ourselves as competitors. Our ratings are not always the same. Very clearly, our criteria are not the same. So we absolutely welcome competition. On domestic debt, that can be a challenge. Typically, we don't rate the local currency debt in most African countries, with very few exceptions. We do. And yes, indeed, sometimes it can be difficult to track the repayment of local currency debt. Actually, we had an issue not too long ago where I think there was a payment default on local currency debt, and we reacted with a default rating action only with a certain delay, precisely because we did not have that information. And maybe that goes back to this ownership question and communication question that I discussed earlier. Corporate ratings, that's an interesting question, very good question. Actually, S&P does not have a sovereign ceiling. So we do look at country risk, but you can absolutely get a corporate rating or project rating above the sovereign. In Africa, we rate publicly or confidentially about 30 sovereigns, corporate ratings, half of them in South Africa. But of those roughly 30, about 2/3 actually are rated above the respective sovereign rating. What helps to get a corporate rating above the sovereign is first, if you're reasonably diversified in terms of your cash flows or revenue, in terms of your assets. And then number two, there are also certain techniques to structure your debt or a transaction so that you ring fence your revenue that you commit to debt service from sovereign or country risk. Future flow transactions is a good example for that. So under that setup, typically you would pledge, for instance, your export revenue to debt service, or at least a proportion of that, and ideally hold it offshore so that it's really ring-fenced and isolated from sovereign or country risk. When it comes to domestic debt ratings, and maybe also to remind you, we also have national scales for ratings. So we have our global scales, the letters, right? We also have the national scales that would typically start with like a country acronym like NG or so, and then NG AAA, NG AA, and so on. And would take too much time to go into the national scale ratings in detail, but by and large, you can look at them like as a magnifying glass, where you start broadly at AAA for the sovereign level, and then you go down, and you can be much more granular when it comes to the local market and local currency ratings. Right. So the question on the cost of debt, that's also a good question, and maybe that actually emphasizes the point that we often make. A credit rating is and should be only one consideration for an investor amongst others. There may be others like liquidity, exactly, maturity or so. There's one example currently where there's a particularly strong difference between the market implied rating. So when you compare the interest cost to the rating level, that's currently actually in the Middle East and Israel, that we just downgraded last week by one notch. But we're still in the single A category for Israel, while the market trades Israel bonds at BB levels, right? So that does happen, and our view on that is we try to look through certain shocks and volatilities and try to rate more to the fundamentals, while the market may be more volatile.
Thank you, Christian. I admire your dedication to answering all the questions, even though there's a flashing light in front of you. Thank you very much. Thank you to all of you. It means that I will just really cut short my last remarks. I think it has become apparent, and we all knew it going into this session. It is a structural issue that needs attention. Credit rating agencies are a part of that structural issue. We need to tackle those challenges, but we also must not be paralyzed by the fact that we need systemic structural solutions. What we need to do, I think, is to, as we said, focus on the really realistic and small and concrete steps that we can achieve, again, maybe until next year at the HSC. And what it will take is political pressure. I'm also looking into my colleagues from civil society, and also, of course, the colleagues from BMZ and others. I think it's also on us to keep up that momentum and that pressure to then actually see concrete next steps that will then hopefully lead us to a solution of those systemic challenges that we all want and need to overcome. Thank you very much.